Hey everyone, Adam here from Wayne State's Financial Literacy Program. Today I'm going to talk about one of the most common questions we get here in our office, and that is what really affects our credit score. So for this quick video, we're just going to talk about the 5 key categories, but if you want to learn more, of course, it's best to make a one-on-one financial coaching appointment with us in our office. And to do that, you can go to success.wayne.edu and find the Financial Literacy Program tab there. But what really affects your credit score? So, again, there are 5 key categories. The number one category that affects your credit score is your payment history, and this makes up about 35% of your credit score. This might seem like an easy thing to forget, and at times it can seem like kind of a little insignificant thing on a month-to-month basis, but if you miss payments, it can have a pretty drastic effect on your credit score. So make sure that you're making your payments on time and you're kind of monitoring your accounts appropriately there. All right, the second category is your amounts owed, and this makes up about 30% of your credit score here. And what I don't want you to focus on too much is the strict dollar amount. That is, of course, important. What I want you to be thinking about is the percentages. And to find out your relevant percentage, or your utilization ratio, that's a fancy term that the lenders like to use, what I want you to think about is your credit limit, right? That is the limit that you have on all your credit card accounts and your current balance that you have. And so let's say that you are a student who has one credit card with a $500 credit limit. You're allowed to spend up to $500 on that card, and so far you've spent $250. Well, what you do is you take that $250 out of that $500, and that comes up to about 50%. So you've used 50% of your available credit limit, right? And so that's kind of what the lenders and the companies are looking at there. Ideally, they want you to be at 30% or lower for your utilization ratio. I, of course, here in the Financial Literacy Program would like to ideally see you at 0%. But if you find that you're above 30%, you really want to work on paying those debts down so you get under that 30% threshold. Okay? The third category, which makes up about 15% of your score, is your length of credit history there. This is a hard one to really do too much work to. Really what they're looking at is what's kind of the average length of all your credit accounts and the length of your different accounts and how long you've had accounts open and in good standing. If you're new to credit, of course this is going to impact you a little bit, but because it only makes up 15%, it's not a huge deal. That being said, it's not really all that smart to rush into getting a credit card or opening up some sort of debt line just because you want to get your credit history started. Really what you should be thinking about is, am I personally and financially ready to make this sort of decision? Next category, which makes up 10% of your score, is your credit mix. Essentially what the lenders are looking at is, are you really good at using multiple types of debt instruments, right? So do you have credit cards? Do you have an auto loan? Do you have a mortgage or a house loan? And are you good at paying down the debts on all those types of debt instruments there? You know, this is one of those things where it kind of happens over time. It's a natural progression there. What you don't want to be doing is taking on debt that you don't need just to enhance your credit mix there. Because it's 10% of your score, it's something that, of course, you want to be aware of, but not something that you want to be too active in trying to manipulate. And the final category, which makes up 10%, is new credit. Essentially what lenders and companies are looking at is, are you applying for a lot of different credit accounts in a short period of time? Really what that can do is signal to them, hey, this person might potentially be looking at taking on a lot of debt in the near recency here. And that might give them a little bit of pause. So it'll potentially lower your score a little bit. Usually it's just for a short amount of time though. So just be aware when you're applying for cards and different types of debt that if it's going to pull a hard inquiry, it's probably going to impact your score at least for a little bit of time. But those are the 5 key categories, and if you know those categories, you kind of know the relevant amounts and how it impacts your score, you can start making some really smart credit decisions and potentially raise your score quite a bit in the coming year or so. If you have any questions, again, just go to success.wayne.edu, click on the Financial Literacy Services tab, and one of our coaches will be able to help you.